Welcome back, everybody. It's time to look for new positions and track some more transactions, so let's get right to it. Here we are in Thinkorswim. We're logged into our paper trading account. We are running the continuous wheel strategy on BITO, the Bitcoin ETF, and we have some transactions that we placed last Sunday that executed earlier this week that we need to track. So coming over here, looking at the account statement, you can see the cash secured put and the covered call transactions right here, and also the cash secured put that we created. Let's see, which one is that right here? Right there, the cash secured put. It was set at $25.50 and the price dropped below $25.50 when it expired this past Friday, so we did get assigned on that. So what we need to do right now is go over to the web application and track these transactions. So let's go right over there and do that right now. Here we are logged into myatmm.com. We go to the dashboard initially when we first log in. What we need to do is come over to the cost basis screen, make sure BITO is selected. It's the only ticker that we're currently tracking right now in this account, so that comes up first. Okay, let's go ahead and bring up the Thinkorswim account statement so we can more easily see that. There we go. All right, so the first thing we need to do is track this first transaction. So this will be the covered call position that we actually already have that we need to roll. So let's come over to our covered calls here, the call option contracts here. All right, we need to roll this one. So this one was for 4 contracts. So you can see we had 2 separate ones, but they were rolled into one during this operation. So what we need to do is I'm going to just create a new one. I think I even did this last week because it's easier to do than just separately rolling these. Since it's 4, you can notice that right here we had sold 4 contracts, so we have 4 total contracts to do. We're rolling them because you can see that these expirations are on the 17th, and we rolled them from the 17th right here to May 31st. So let's go ahead and do that. We're going to create a new draft position. The start date, according to Thinkorswim, is May 6th. So select May 6th. It's going to be a sell to open. It's going to be a call contract. We did 4 of them. The expiration is on the 31st of May. The strike, it looks like we rolled down from 30.50 to 30, as you can see right there. So type in 30. The price that we got it was this at 30 cents. So we plug in 30 cents right there. And that'll give us the 120 that you see right here as well over on Thinkorswim, the 120 right there. All right, so click Save. And what we can do is go ahead and remove these other positions to clean those up because this one represents those previous ones. All right, we need to make sure that the transaction gets saved. You can notice right there that the transaction fees were $5.20. The one that was put right here for proposed was only doing one side. It wasn't considering buying the ones to roll. So Thinkorswim, of course, is, and it's for 5 cents. Move that helper down and then click Save to retain that to the permanent transaction history. All right, so that one is tracked. We need to go to the next one. This is where we were assigned last week as well on the cash secured put from 2 weeks ago. So we had another 100 shares to write another covered call on, a 5th contract. So that's what this line is here in Thinkorswim. So create a new position. The transaction date again is May 6th. It's going to be a sell to open, a call, 1 contract. The expiration again is May 31st. The strike that we did that at was 30. And we did the strikes at 30 because you notice our cost basis is $29.70, so we can safely do a strike at 30 and we won't have to worry about losing any money if the price does start going up and we get called out. All right, the price that we received on that was 41 cents per share. So click Save there. So that's 41. Here's the $41 minus 65 cents and 2 cents for the fees. Click the up arrow there, move that down, save that also to the permanent transaction history, and there we go. We have those covered calls tracked. Now we need to track the cash secured put. All right, so add another position, May 6th again, sell to open. This is going to be a put. It's going to be 1 contract. The expiration is going to be May 10th. which was this past Friday. The strike that we did that at was 25.50, as you can see right there in Thinkorswim. Okay, the price that we did at was the at 49 cents. Let's click save there. It moved into this puts group right here, and the proposed transaction was right here, 49 minus 65 cents minus 2 cents for the fees. And I'm getting these numbers right here from this highlighted line of Thinkorswim that you can see. All right, so move that down. It does the calculation for me, subtracting the commission and fees. Click save. That also is now saved to the permanent transaction history. Okay, so we logged the covered calls and we logged the cash secured put transactions, and now we need to cover this assignment. So what happened is, as you can see, these covered calls expiration's not till May 31st, so that's, you know, a couple weeks away, so that's not on the radar right now. This one, however, expired this past Friday, and the strike was 25.50, and you can see the last price was 24.64, so obviously that was lower, so we did in fact get assigned on that. So what we can do is click the result drop down to do assigned, and the assignment date from Thinkorswim, it says May 11th, so we can just put May 11th for that one, and it's going to be a buy to open, and it's going to be stock, and it's going to be for 100 shares because there was only one contract. The assignment price is the same as the strike for this contract, so that's where the 25.50 is coming from. So when we click submit here, it's going to add a stock record to up here, so you can see there's currently 5 transactions. So I'm going to go ahead and expand it out so we can see them, and scroll that up, not a little too far there. Okay, right there. So we can see the 5 current records of all the shares that we own, and this submit is going to add a 6th one. So go ahead and click submit, and then there's that 6th one that I showed you right then. And now we can take this off the board because we no longer need that represented. Let's go ahead and collapse the puts, and we'll collapse the calls. And what we need to do is make sure that this this new stock position is added to the permanent transaction history. Just doing that submit and it moving it up here, it did not create a proposed record. So what we can do is click save here. That'll generate the proposed record. And then there's no commissions, no fees. We can move that down, and it moves it down. It toggles this. This toggle indicates that it is a stock and not an option contract. Click save, and that one is retained now in the permanent transaction history too. All right, so let's just review where we're currently at with this position, BITO. We currently have 600, let's go ahead and collapse this too. Okay, so we currently own 600 shares. Total cost involved that we paid for the 600 shares is $17,400. As you can see, the current stock value based off the last trading price is $14,784. We currently have an unrealized loss of $2,616. Overall premium that we've collected on this position is $1,171 and some change. So, you know, total overall, if we were to liquidate all 600 shares, we would be negative by about $1,400, $1,500, something like that. But we don't liquidate position. We only get involved in a position or a stock that we don't mind owning because we believe in it, or, you know, whatever the case may be. And also this one does pay a dividend. So even if we get holding it for a long time, we'll still be getting the dividends at least on it. But the funny thing about it is we're still actually collecting premium. It's dropped all this way, and we're still collecting weekly premiums on this position. So we're going to just continue doing the same thing. You could just stop here. Like if you wanted to stop putting collateral in here, you could just run with the covered calls. You could just continue just selling covered calls on this and then just sitting on this. The only reason we're running the puts is because we're playing both sides so we can continue collecting premium, but we're also lowering the cost basis while we're doing this. And I will admit, in real life or using real money, I actually don't do exactly this. So I will create the cash secured put, but I actually watch the cash secured put and I watch its extrinsic value. And when the extrinsic value gets below 0.1 or 10 cents per share, I look to roll it to a week out or a couple weeks out to continue collecting premium. So The only time that you can't start collecting premium on that is when the stock prices drop significantly, and then you can't get a decent premium, just 30 days out. If you go far enough out, you probably could collect some amount of premium, but I don't like running anything longer than 30 days. It's just personal preference. So it would limit the amount of collateral that we keep on dumping into this position by selling cash secured puts every single week. Because as you'll notice, we purchased this at 32. We purchased another one just 50 cents lower, like another contract, another 100 shares. And this one, that one's $1.50 lower at least. But see there again, 50 cents, again, just $1 lower. And this one finally dropped $2 lower. But the funny thing about it is, at the very beginning, the $32 cash secured put, we could have rolled that this week and we wouldn't have been assigned at all. We would have just reutilized the same 3,200, rolled the cash secured put, collect some more premium, and we wouldn't have had to put another, cash secured put on the board. We wouldn't have had we would have only had that one cash secured put from the original first cash secured put position that we set. So 31.50, we could have rolled this one because 50-cent difference, we could have collected some decent amount of premium even in a week on this ticker. $29 still probably could have rolled it at least a week or two out and still collected some decent premium. 28.50 still. 27, that's might be pushing it because 27, that's a $4.50 different. So depending on the higher price stocks, $5, $10 isn't too big of a deal. You can still collect pretty good premium regardless. So you could sit there on the same initial 3,200 and just keep on rolling it and rolling it and rolling it and rolling it and collecting more and more premium. Now, obviously, the premium that I collected initially when the price was right at 32 would be much higher than, like, if the price was down at 28.50, I wouldn't be able to sell a cash secured put option contract at $32 for as much premium as I did back when it was trading at 32. If it's only trading at 27, I'll get less premium. But I will be reutilizing this same $3,200, and that's the key difference, because not everybody has, like $100,000 to just keep on pouring into the same stock and dollar cost averaging. So what I do is I just reutilize the same initial capital, roll it as long as I possibly can until I can't collect any decent amount of premium within 30 days. When that happens, I will let it get assigned, and then I'll start trading covered calls on it if I can collect decent premium within 30 days, and in addition, I will start selling a cash secured put again on the lower stock. So basically, covered call at 32 and a cash secured put at 25. So that way, if this one would have to drop down to $20 or whatever before I'd actually let it get assigned. I would also roll it continually until I couldn't do it any longer. But that would limit the amount of collateral that you have to put into each stock. Since this is a demo account and a paper trading account, I'm actually just taking the lazy way out and not rolling anything and just letting them get assigned as they come in, because it allows me to demonstrate that the usage of this application and what it's capable of, and also demonstrates the cost basis, dollar cost averaging, and all the calculations built into the application. It allows you to see that and for me to demonstrate it. So that's the main reason why I do it this way. Not to say it doesn't work this way. It still works. It's still doing what it's meant to do. And if and when the price does start creeping back up, we're setting at $29. So we don't have to count on this stock this ticker going back up to 32, which is where we started at. We don't have to count on it doing that in order to get out of this position. All it has to do is come back up to 29, and then we'll be able to get out. So it never has to go back up to 32 ever again, and we'll still come out making money and breaking even if it did that. So as you can see, our current cost basis now is 29. I think it was 29.70 before, which made us have to sell covered calls at 30, as you can see. But now that it's at 29, this week we can actually roll these down $1, roll them down to the 29, and that will only be on 5 contracts. We own 600 shares, so we can sell another covered call at the $29 price. And again, as usual, look for a cash secured put to roll or to execute as well. All right, so that's what we need to do. We need to go over to Thinkorswim to look at that. But before we leave this application, I want to go ahead and just check the dashboard amounts just to verify that we are reconciled completely. So the brokerage account is showing $84,796.40, and as you can see right over here, $84,796.40. So we are matching exactly, so we are fully reconciled. And before we leave this web application to look for those new positions, let's just see how our premiums are doing. So April we collected $967, and in May we've collected $203.41 total thus far. Okay, let's go over to Thinkorswim right now and look to roll those covered calls, create another covered call contract, and create another cash secured put contract. Let's go do that right now. Okay, here we are back on Thinkorswim. We need to go ahead and get the cost basis up on the screen so we have that for reference. There we go, that's showing now. Okay, let's go to the account statement. We can see we have those 500 shares, and we have this covered call contract. There's actually 5 of them that we're running right now. Our cost basis, as you can see on the screen, is $29, represented right here in the web application. So these covered calls right here are setting at a 30 strike, and let's look to roll those down first to the 29 because that's all we really need to sell them for, and we can probably collect a little bit more premium on that. Okay, so by default, when you roll an order, by default it pushes them out a week by default and sets it at for the same price, the same strike price that the original one was selling for. But that's what we want to do first is we want to see. Let's just set it for the same date, and as you can see, it's zero price because it's the same. We're buying and selling the same contract, so there's no reason to do that, except for the fact we're going to try and lower the strike price. We can lower it down to our cost basis, which is 29. So let's select 29, and you can see by keeping the expiration the same date but lowering it $1 in strike, we can collect 6 cents in premium. That's generally not enough for me to even bother with it, so I'm looking for anything more than 10 cents, preferably 12, 13, 14, or more, of course. So we're gonna have to push this out one more week to see what we can get. And also, before we do that, notice that this is for BITO and this is not BITO, that's TNA. Let's click on BITO so we can get those positions up on the board. So right now, May 31st, you can see that's 19 days away. Now this is the covered call too, so that might adjust things. But so I would feel safe. I was saying 30 days, and 30 days is about the thing. It's either 30 days or the next monthly is also one thing that I will consider doing, the next monthly, which this one's only 5 days away, so that's way too close. All right, so let's go ahead and push it out 1 week. And then so the June 7th will be 26 days, as you can see in this parentheses right here. And that's giving us 12 cents. And I will just go out another week just because I want to see what the change is. So as you'll see right here, coming back to the same date, it's only 6 cents. Going out one more week, it doubled to 12 cents. So the next week out would be June 14th, which would be 33 days, which is close to the cap. And the only reason I would go a little bit longer than that, again, is because it's the monthly. So let's go out one more week to June 14th, which will be 33 days, as you can see right here in the parentheses. And whoa, look at that, man, that jumped up a lot. All right, so let's come back here. So see, 12 cents, but going out there, we're getting to 56 cents. I wonder what the monthly would be if I jumped out to the monthly. Look at that. Okay, it's probably just a glitch. Sometimes the option premiums get glitched over the weekend and they don't reset or correct themselves till market opens on Monday. So I'm thinking that's a glitch. So let's actually just expand this. So this is 29. So this is June 14th. So we're going to expand that. And this is for the $29 strike, which is right here. Yeah, see, it has this wild ask price and then a zero bid. So this is not legitimate. That's not going to play nicely. So we're looking specifically for 29, and there's a lot of numbers here, but if we want to just isolate this, make it easier to read, we can actually just filter down to strike prices of only $29. So we will only see the $29 strikes. So as you can see, for 5 days away, $29 strike, the bid's 3 cents. I mean, the mark's 5. You should be able to get whatever the mark is. So there, 12, 22, 28, 73. But you have to keep in mind we're rolling. So we have to buy back this one and then sell this one to make the difference. Just straight up selling these, obviously you would get more just selling one without having to buy the other one. So we're having to buy and then sell. All right. So right here, this is just a glitch. It will fix itself when the market opens. So this mark is invalid. It's most likely, and see even here, the spread right here, 16 to 41, that's too big of a spread. So that's glitched too. It's not gonna really play out that way. These numbers look more legitimate. 2 cent, 3 cent spread, that looks more accurate. So 11.21. So this one's probably really going to be around 30 cents. This one might be 40, 45, 50 or so, because this one's 45.50, so it's probably somewhere in between there. All right, so I don't trust that one at all. So let's come back down a week to June 7th. 12 cents is probably going to be the best we can do on this. And I don't want to try 13 cents on a roll, so we're just going to stick to 12 cents and stick this, because that way it'll still keep it close to the expiration, or to within the 30-day window. I like staying within 30 days because if the price starts moving back up, then the price of the covered calls are going to start going back up too. And I want to make sure that I can capitalize on, if the price starts going up, I can sell the covered calls for more money to collect more premium. So we're going to stick with this one because June 7th is 26 days out. So that's still far way out. But anyway, let's go and stick to that. We'll go ahead and click confirm and send. And again, remember, this is on 5 contracts, so it's going to be more than $12. So we're collect about that, the $53. All right, click send. So that order is queued. Now we need to look for just a single covered call contract to sell, because now, again, we own 600 shares instead of the 500 or the 5 contracts that we currently have. So we need to sell one more covered call contract. And I like to keep them the same day so we can combine them and keep them all together. So it just makes sense. So we are trying to roll this one to what? From May 31st to June 7th. So what we want to do is June 7th, we want to try and execute this one. And this one may or may not play out, because again, that's a big gap there. So I'm thinking that one might not play out tomorrow when the market opens. The roll might not actually happen. It might want to do less than that. We might get lucky and it might happen. So I'm gonna have to just wait and see. I might have to adjust that one, or even maybe push it out a week to get that to happen. We'll just see then. But for right now, we're gonna go ahead and do one more contract right here. So you just left click on the bid, and according to this, the spread is that big, which that's probably not a legitimate spread. It's probably gonna fix itself. But we're gonna go ahead and just stick to the numbers. And the mark is 28, so we're gonna go ahead and up this to 28, because theoretically we should get that. But again, that spread's big, so it looks like it's not legitimate. It looks like it'll fix itself come Monday when the market opens. But we're going to go ahead and run with this. We're doing one contract, selling at 29 strike. Confirm and send, so that'll be another $27 we can collect. Go ahead and send it off. All right, so now we have the rolling covered calls, and we have the one contract that we're writing. So that's a total of 6 contracts. Now we need to look for the cash secured put. So right here, we want to go down to 4 strikes, and we need to make sure we clear this because we were filtering down to just 29. So reset. All right, and we don't have to look at all of these, so let's go ahead and just collapse them all. Look at the next upcoming Fridays, $24.50. So we can collect $59 for that. Let's go out a week just to see. So 59, 87, not too much improvement. And then 89, not improvement at all. 91, yeah, so 59 is the lion's share of the cash secured put that we can collect. All right, so what you do is you left click on the bid right here, and the mark is, or the midpoint between the bid and ask is what the mark is. The mark is at 61, so we can up that a couple pennies. We want to do just one contract. Go ahead and click confirm and send. We should get to 60.35. All right, go ahead and send that off. Okay, so now we have the rolling of the covered calls order queued. We have the new covered call contract queued, and we have the cash secured put order queued. So now we will just wait until tomorrow when the market opens to see how those orders play out. Make sure they execute, adjust them if they do not, and we'll wait till next week to review and see where we're at. I want to thank you for watching. Like and subscribe if you haven't already, and go out today to myatmm.com and get your free account so you can start tracking your own transactions. Thanks, and I'll see you in the next one.